The CMHC is not working for you. You being the average Canadian, the CMHC is there to help the average Canadian. They have not done so. They are not doing so. And that is what we'll explore on the podcast today. Welcome back to The Last Honest Realtor. I am your host, David Fleming. And today I want to answer the question, why isn't the CMHC working for you? As I said, who are you? You could be a person that's actually benefiting tremendously from the CMHC. But of course, if you are you, the average Canadian who this is geared towards, it's not working for you. So I'm not even going to say, is the CMHC working for you in today's title? Because I don't believe it is. I don't believe it has for a long time. And today I want to explore what the CMHC is, what they were supposed to do, what they still say they're doing, whether or not they're doing it, and of course I'll explain why they're not. Now I want to introduce you to one concept right off the bat. And this has no context whatsoever, but I think it's a pretty good starting point. The CMHC wants to make housing more affordable. And to do that, their idea is to make it more expensive. Because follow the logic here. If they make housing more expensive and more difficult to buy, then fewer people will buy it. And if there is fewer people buying homes, then that means demand decreases. And in the relationship between supply and demand in a free market, when there's less demand, prices decrease. Is that the most ridiculous thing you've ever heard? To me, it is. But I didn't make that up. That is what the CMHC has been doing for years. They have been saying, we need to make housing more affordable. Their idea is not to, build housing. Their ideas are always about decreasing demand. And the way they've done that is by decreasing affordability. It's the craziest thing ever. So that's my hook. I hope you're going to enjoy this. Some of you might think that this is elementary because I'm going to start with what the CMHC is, who they are, what their mandate is. And some of you might not necessarily love the mortgage math, but I promise by the end of this, you will understand what is the CMHC supposed to do? What are they saying they're going to do? And why are they not doing it? Why isn't the CMHC working for you? So the CMHC has a very lengthy list of goals per their mandate, but it's my contention that the CMHC, what they set out to be in 1946 and what they say their mandate is no longer anywhere accurate in 2024. Now, here's a funny thing. If you go to the CMHC's website, it's incredibly ironic. On the front page of their website, it says, CMHC is more than mortgage loan insurance. They beat me to my own punchline. One of the things I had planned to say was, all the CMHC really does is provide mortgage loan insurance, which of course is not what they were supposed to do when they set out. But on their website, it actually says CMHC is more than mortgage loan insurance. It's a case of methink thou doth protest too much. If they didn't think that everyone believed that's all they did, they wouldn't put that on their website. Now here's what it says on their website. We delve into research, explore innovative strategies, collaborate with industry professionals and innovators to fund affordable housing opportunities, to create a Canada where everyone has a place to call home. Sounds like fluff to me. We also offer plenty of housing information for consumers, like tips on renting, purchasing, and owning a home. I mean, you guys already have tips on renting, purchasing, and owning a home from my blog and podcast and other things like it. I mean, I would probably listen to 10 or 12 other economists and real estate agents out there before I listen to the tips and tricks from the CMHC. Now, I want to talk about how the CMHC started, but some of you might find that a bit dry. So first, let me say this. I have said for the longest time that there are two sides to the supply and demand equation. If we're talking about affordability and we're saying that prices are too high, we have to understand that in any free market where price is determined by the interaction of buyers and sellers, you have demand and you have supply. Now, if prices are going up, it obviously means either there's too much demand or there's not enough supply or both. I believe that for as long as I've been in real estate, the CMHC, as with every other government and or politician, have all looked at demand. Every idea that they've had to alter the relationship between supply and demand in the quest of making housing more affordable relied on demand side solutions. And I've been writing this on my blog for probably 10 years. I'd say about 3 or 4, maybe 5 years ago, we started to see more politicians and more media articles about increasing supply. But listen, if you've got a town and it's got 100 houses and there are 120 people looking to buy, well, you have a deficit of supply. So you could either ensure that 21 of those people can't buy, thereby making there slightly more houses than buyers, or of course you could build 20 more houses. So that's a very basic example. But essentially everything I believe about the CMHC and all of my critiques stem from the fact that all of the changes they've implemented have been on the demand side. And I will say one more thing before I get into what I described as the sort of dry history, is that the CMHC has had one massive success to their credit, and that is helping to ensure that Canadian banks are the safest place to store money in the entire world. That's not a joke. Because when the 2008 financial meltdown happened, as we saw, Canadian banks completely unaffected. So let me go back. As I said, I want to talk about the history of the CMHC. So this is from Investopedia. The CMHC is Canada's federal crown corporation responsible for administering the National Housing Act with a mandate to improve housing by living conditions in the country, established after World War II to help returning war veterans find housing. That was when it started, 1946. That was their mandate, to help people find housing. Now, it's obviously evolved because that was quite some time ago. It has since seen its mandate expand to the mandate of improving access to housing overall. Okay, so it's not just about mortgage loan insurance. We're talking about helping people get into the housing market. The CMHC operates with a primary mandate of providing mortgage liquidity, assist in establishing affordable housing development, and provide arm's length advice to the Government of Canada and housing industry. I don't know how arm's length it would be. Yes, it's a crown corporation, but I do believe, as I always have, that the CMHC and whatever government is in power is probably going to work in lockstep. The Crown Corporation acts as Canada's national housing agency. As such, it administers federal housing programs, such as the first-time homebuyer loan, acts as a mortgage insurer. Yeah, no kidding. We'll come back to that, primarily for high leverage loans, and provides housing research. I could go on. But let's just say there's what the CMHC set out to be, what the CMHC says that they are, what they intend to be, and then there's what they actually do. And so as I said at the onset, when you go to their website and it says the CMHC is more than just mortgage loan insurance, that to me is a huge red flag that they believe the perception is that's all they do. Now, what is mortgage insurance? So I'm going to read this from, again, the CMHC's website. This applies to any high ratio mortgage. That, of course, is a mortgage with a loan to value of 80% or greater. Or if you flip the numbers on that, if you have a 5 or a 10 or a 15% down payment, you are high ratio. Mortgage loan insurance is typically required by lenders when homebuyers make a down payment of less than 20% of the purchase price. That's what I just said. Mortgage loan insurance helps protect lenders against mortgage default. Those are our banks, and enables consumers to purchase homes with a minimum down payment starting at 5%. Without it, of course, what they're saying is you wouldn't be able to do so. With interest rates comparable to those offered with a larger down payment, and to obtain mortgage loan insurance, lenders pay an insurance premium. Typically, your lender will pass this cost on to you. So what we're saying here is that the banks, the big 5 banks for argument's sake, are able to give terms and conditions favorable to borrowers because the CMHC is insuring the mortgages. Banks don't want to lose money. I think we know that. If a borrower defaults on a mortgage, the bank could potentially lose money. The CMHC is backstopping this. So one of the biggest critiques of the CMHC, and you could literally Google critiques of CMHC, there are a lot of Canadians that don't believe the CMHC should be backstopping mortgages, backstopping the banks, and effectively propping up the entire housing market at the risk of the Canadian taxpayer. So as far as propping up the housing market, we'll come back to that perhaps at the very end. But point being, if you're a senior and you own your home in cash and you've worked hard your entire life to pay it off and you never had CMHC mortgage insurance, now you're saying, why am I as a taxpayer being exposed to billions, if not soon to be trillions of dollars in loans by a crown corporation that's decided to act as a safety net for the banks? That is what mortgage insurance is. And to me, the CMHC has effectively become a backstop for the banks. Now, they do also write policy. And this is what I want to focus on today, already having described what they are, what they're supposed to be, where they started, and of course, the backstopping of the banks. But the CMHC continues to refine mortgage and lending criteria. And if I were to start from the very beginning, when I got into the business in 2004 and walk you through all of the changes they've implemented, this is where you will start to see my thesis come into play. My thesis being, of course, that they have tried to make housing more affordable by making it more unaffordable. I'm serious on that. Taking demand out of the market will lower prices, but in doing so, you've just made it less affordable to make it more affordable. The thing's absolutely crazy. It doesn't make any sense. And as far as why isn't the CMHC working for you, I don't want to sound xenophobic here, but I'd be remiss if I didn't say, if you are the steel worker in Hamilton and you're scraping together a down payment to buy a property, and the CMHC, through its mandate to cool the housing market or tighten the housing market lending criteria, makes it more unaffordable for you to buy a home, it really doesn't stop the person that comes to this country with a bag full of cash and buys, right? And I didn't say it first. This all started in 2016, 2017, when we used to see articles written about foreign buyers. And I'm not the only one saying this, because didn't the government ban foreign buyers? Justin Trudeau did that and extended it. Didn't both the province of Ontario and the city of Toronto bring in foreign buyer taxes? So yeah, I'm not the first one to say that. But I would ask the question, is the CMHC working for you, Mr. Wheat Farmer in Saskatoon? Because it's a lot harder to buy a property than it was in 2004 because of all the things that I'm going to discuss starting now. So I want to take a trip back to 2004, not just because that was probably an easier time in my life in the world, but no, because that's when I started in real estate. Now, right now, you can buy a property with 5% down. Can you imagine buying a property with negative 7% down? True story. I'm not making this up. It was called 107% financing. So I sold a home in 2007, and my client paid $1 million for it. My client ran a hedge fund. My client believed that he shouldn't be using his own money because he could make a killing in his hedge fund. And so he took advantage of the CMHC's 107% financing program. He put a $50,000 deposit, that's your check, down with his $1 million offer, which was accepted. It was executed, the deal was closed. On the day of closing, the bank advanced the $1 million to the seller to pay for the home. The bank then returned to him the $50,000 deposit plus another $20,000, which he was basically tacking on to his mortgage. 107% financing. Do the math. This man bought with zero down. The bank gave him an additional $70,000. Now that was in 2007. 107% financing. So it's kind of funny because when you look at the market today for lending and you say over $1 million, as we know, you need a 20% down payment. Can you imagine a time when you could buy with negative 7%? I'm not making this up. As I said, this is a real story. I remember the client. So if we're going to rewind, I said 04 was when I started, but this deal was consummated in 07. If we're going to rewind 17 years, you can see right off the bat how much the lending criteria has changed. And again, as I said, to the credit of the CMHC, the only real success story that I think they have is that they have strengthened our banking system and our lending criteria to avoid a catastrophic collapse like we saw in 2008. Now, another relic of yesteryear is the 40-year amortization. So for those not aware, the amortization period is how long it takes for you to pay off your loan. It's not the 5-year fixed rate, right? 5 years refers to the term. That's how long you get your rate for, but rather how long it takes to pay off the mortgage. And so right now in 2024, most people are on a 25-year, some people are on a 30, but back in 2006, 7, 8, you could get a 40-year. And the CMHC, of course, did away with that as well. But I want to walk you through some basic math just to illustrate why this was important. Let's say you purchased $1 million home and you had your 20% down payment. Assuming a 4.99% 5-year fixed rate, don't worry about any of that, folks. Just consider these two numbers. On a 40-year amortization, your monthly payment was only $3,285. On a 25-year amortization, your monthly payment was $4,648. So what we're saying here is you could lower your monthly payment with a longer amortization by $1,400 per month. Let me say that one more time. You bought $1 million house in 2005. Instead of paying $4,600 a month, you're paying $3,300 a month. I rounded the numbers. That was what the 40-year amortization did. It helped people lower their payments. The problem with it, and the reason that the CMHC, like scrapping 107% financing, the reason the CMHC said, no, we can't do this, is because people weren't paying down enough principal. So in the first case, on a 25-year amortization, where you're paying $4,650 a month, your first payment is 29% in principal, 71% in interest. On the 40-year amortization, you're only paying 14% principal and you're paying 86% interest. So what the CMHC was effectively doing was protecting the consumer from themselves. Because 40 years, what about a 45 or a 50? What about an interest-only mortgage? Think about the idea of an interest-only mortgage where you're going to pay $4,000 a month and zero is principal. It's all interest. That's not helpful. I mean, it helps you lower your payments. But if we're thinking about the grand scheme of things, if you have people walking around who are not paying down any principal, they are incredibly susceptible to a market shift. And of course, if that's one person, then that could be others, that could be many. And the what if factor. What if the market did decline? Say it only declined 10%, 15%. If you've got people that have been in the house and they've been paying off principal, they're not going to get hit as bad as the people that have this idea of an interest-only mortgage. So again, while I am critiquing the CMHC today, I'm walking you through the changes that they have made because it has massively increased the security of lending institutions and the entire system that we have here in Canada. So as I said, our very first thing that we got rid of, thank you CMHC, 107% financing. They got rid of this and they changed it to a minimum 5% down payment. The second thing was removing the 40-year amortization and maximum being 30 years, in most cases 25. Now, it's around this time that in 2008, we experienced a financial crisis in the United States. And you've all read The Big Short, or at the very least, you've seen the book. Some of you are listening to this and you were personally involved in that meltdown. I don't mean that, you lit the fire. But I'm saying that in layman's terms, I'll explain what happened. And some of you can say, well, geez, there's a lot more to it than that. Yes, of course, there are books, courses, seminars, movies about this. Effectively, you had three things happen. First, you had lending criteria that was so lax that, as we saw in the movie The Big Short, a hairdresser could get a loan for their 6th spec townhouse. The second thing that happened was you can sell debt. You can sell an account receivable. Think about if you were part of Columbia House in the 1980s and you got the 12 CDs for a penny and you didn't realize you actually had to buy 2 CDs every single month, and you're like, I'm not doing that. If you're like me, you were 12 years old, and a collection agency sent you a notice. True story. That's what Columbia House did. They sold their accounts receivable. So maybe I owed them $100 and they sold it for $70. That's what can happen with any debt instrument. And so you can sell mortgages. That's a loan. That's an account receivable. And so you had these mortgage-backed securities, which were basically a package of mortgages. And as they explained in The Big Short and every other book and seminar, if you were to take a whole bunch of crappy mortgages, which people didn't know were crappy, and put them all together, and I think they called it the layering on the inside and the outside, say the first card and the last card on the deck, so to speak, were A+, then it could look like a very secure investment. And the third thing, which we saw in the movie, was that the ratings agencies were all so afraid to rate these things anything less than AAA, because I think there was a great scene in the movie where, Moody's said, well, if we don't rate it AAA, they'll go up the street to, I can't remember the name, XYZ rating agency, and they'll do it. So this was the perfect storm. And eventually, as we saw, the Christian Bale character who called this, it was Michael Burry in real life, who called this, but you're probably familiar with the movie. So yes, it was Christian Bale, in a great role, one of my favorite actors ever. Called this entire thing and made a ton of money on it because he effectively shorted the housing market. No one would ever short the housing market. The housing market's too big to fail, but it did. And in 2008, we had a massive meltdown. Now, why wasn't Canada affected? Well, there's a book called Why Didn't Canada Have a Banking Crisis in 2008? And I want to read you a couple of excerpts because this is going to be very interesting. The stability of the Canadian banking system is not a one-off event. In Canada, the banking system was created as a system of large financial institutions whose size and diversification enhanced their robustness. In the United States, the fragmented nature of the banking system created financial institutions that were small and fragile. In response, the United States developed strong financial markets and a labyrinthine set of regulations for financial institutions. Can't read today, folks, I'm sorry. So it continues, the contrast is striking. While in 2008 and 2009, the United States experienced bank failures, bailouts, and the worst recession since the 1930s, Canada had no bank failures, no bailouts, and its recession was less severe than either that of the early 1980s or early 1990s. Are you listening to this? This is crazy. Now pick this up. There's a Fidelity.ca article that I just read from 2003, playing off the same idea. They said, during the darkest days of 2008, Canada experienced no bank failures and required no bailouts. Then as banks collapsed south of the border, the World Economic Forum declared Canada's banking system the soundest in the world, just ahead of Sweden, Luxembourg, Australia, and Denmark. There have been 564 bank failures in the US since 2001. Over the same period, Canada has had none. The last time a Canadian bank failed was 27 years ago when the Calgary-based Security Home Mortgage Corporation was forced to close its doors in 1996. When I said that Canada's banking system was the safest in the world, you might have thought that I was just ad-libbing. 2008, World Economic Forum declared Canada's banking system the soundest in the world. So after the meltdown in the United States, the CMHC continued to chip away at all of the existing regulations that existed for mortgages in Canada. So as I said at the onset, we have 107% financing gone. You need a minimum 5% down payment. You've got 40-year amortizations gone. Now it's 25 and in some cases 30. The next thing that they did was institute a minimum of 20% down for anything over $1 million. Think about that today. You're saying, yeah, of course. Of course, we all know that. If you're going to buy for $1 million, you need 20%. If you're going to buy for $2 million, you're supposed to have 20% of the first million and 50% of the next million. Although most banks will make an exception and give you 20% of everything. So it's kind of hard to imagine today a time when you didn't need any money down and got 7% cash back. So it's kind of hard to imagine what the reaction was somewhere around 08, 09 after the meltdown in the United States when the CMHC said, no, you now need to have a 20% down payment over $1 million. Now this was massive in the marketplace. And again, if you think about what I described earlier as the CMHC attempting to make housing more affordable by making it less affordable, this is what they did. And there were all kinds of people at the time that said, I have been saving and scraping and clawing to get my 5% down so I could go and buy the $1 million house that I want. And I've got my $50,000 and now you're telling me I need $200,000? The response to this from the banks and economists and other interested onlookers was, hey, great move. This is going to make banking really safe. The response to this from Canadians was, how dare you? And again, I go back to, and I don't want to talk about this concept of an evil foreign buyer, but I go back to the idea about Joe Canadian, who has been looking to purchase a home, and you've moved the goalposts on him. We had a minimum 5% down payment. Of course, originally we had 107% financing, but let's say we had a 5% down payment for Joe Canadian, and he's got his $50,000 looking to buy his $1 million house, and now you say, sorry, Joe, you need $200,000. But meanwhile, anybody who comes to this country with cash, they're still buying. And I know how that sounds, but I also lived through that. And I witnessed firsthand. I had clients that said, I can't buy anymore. The regulations have been changed. Now, we also have to think about investment properties. Part of the issue in 2008 in the United States was, as I said, and sort of paraphrasing from The Big Short, was when you run into, the nightclub dancer or the housekeeper. These are from the book, by the way. I'm not being a jerk. These were examples, right? Or the hairdresser or the taxi cab driver that just bought their 6th townhouse. How much money were they putting down? Were they putting down anything? Were they showing income? Remember Ninja loans? Ninja stood for no income, no jobs or assets. Again, if I'm going to give you guys any good ideas today, it's to go watch The Big Short. But I can remember scenes from this movie where they're talking about ninja loans. There's guys that are joking around. They formerly were bartenders. Now they're mortgage brokers, and they're making sure that a cab driver can buy his 7th property. In Canada, the CMHC up next instituted a minimum 20% down payment for second properties. That's great. I can honestly say that's great. Yes, I'm here to critique the CMHC today, but imagine running around buying with 5% down. Now, this was in 08, 09, 2010, but imagine what that would be like today. Imagine if you were buying $500,000 condos. Right now, you need $100,000 down. Imagine if you only needed $25,000 down. Think about how much the market has increased over the last 5, 10, 15, 20 years. Imagine if you could go and buy with 5% down instead of 20% down. I think way more people would own way more investment properties. And again, increase in demand pushes prices up. So that was a very important change in the context of keeping the banking system and the mortgage system safe. Now, the CMHC had another really good idea, and this is going years later. I mean, one of the smaller things they did do is they increased CMHC premiums. Now, this is where I talk again about the idea of making housing more affordable by making it unaffordable, in that when you increase CMHC premiums, you're just making it more expensive for people. So if that's the case, fine. But it doesn't really do anything to help Joe Canadian. After that, and we're going to about 2016, 2017, we first hear about the mortgage stress test. You've all heard of this, and I cannot believe that this is now 7 years old, but this might be one of the biggest changes ever. And I'm going to take a quick break, and we'll come back and flush that out. Welcome back, and just before the break, I had mentioned something called the stress test. Now, 2024, this is pretty common vernacular, and boy, 7 years goes by pretty quickly. In fact, I believe it was the fall of 2016 that we were rumored to be getting this stress test. Just the name alone stressed us out, no pun intended, but actually, yes. So effectively, the stress test was a way to take demand out of the market. Another attempt by the CMHC to increase affordability by decreasing affordability. Now, I will say this, because we had a pandemic, because rates plummeted and then rates skyrocketed, this was genius. And it might have saved, I don't want to overstate this, might have saved the real estate market, might have saved the economy. What it did was save a lot of mortgage defaults. But that was, in my honest estimation, an unintended byproduct. I don't want to give the CMHC credit for seeing that coming because, of course, who saw the worldwide pandemic coming with interest rates effectively being zero, and then us seeing 10 straight interest rate increases in 2022 and 2023, of course. So cooling the market. That has been what the CMHC has wanted to do for oh so long. And this probably started in 2016, 2017 with stress test talk. It definitely happened in 2017 in the month of April when all 3 levels of government were talking in front of podiums about cooling the market and increasing affordability. And of course, that's when we had this massive market decline. But the idea of the stress test was to cool the market. In fact, there's a quote from a CMHC. They said the stress test is going to, quote, cool down an overheated market. So from my perspective, I could have said the stress test is a brilliant way of ensuring the market and its borrowers are immune to future interest rate increases. That's what I would have said. But instead, we got this cool down an overheated market. So if you were to Google stress test 2017, I'm sure you could find articles that only talk about making the system safer. I'm sure you could find articles that only reference what the CMHC is doing to ensure that borrowers can afford their payments in an increasing interest rate environment. But at the time, and I'm speaking anecdotally, all of the talk was about cooling the market. And again, I go back to this idea that the CMHC for 15 years has implemented all of these policies and these policy changes with the aim of increasing affordability by decreasing affordability. We're going to cool the market. That means we're going to take demand out of the market. And that means we're going to do that by making it harder to buy. So what the stress test was and is, and many of you already know this, but if you have a mortgage rate of 5%, you need to qualify at, say, 7%. So we're talking about the qualification. We're not talking about what you're actually going to pay. But again, I said this is brilliant and genius, and I mean it. Because if you are buying to your absolute max, 5%, that's the rate that I'm qualifying at. That is the rate I'm going to pay. And I'm maxing out. I'm blowing my brains out. I've got a $1.1 million mortgage pre-approval and I bought for 1.1. Well, what if rates increase? Are you going to be able to afford your payments? So what the CMHC did is they stress tested all of the buyers. And this is for insured mortgages. For uninsured mortgages, those of high ratio, where these people were paying the insurance premiums, we discussed that, right? CMHC insurance premiums, because the CMHC backstops the banks and they insure the mortgages. We had already seen that happen. But now we're talking about people with 20% down or more. They have to be stress tested. So at the time, the buyers said this is so incredibly unfair. As soon as the stress test came in, somebody that might have been able to afford 1.5 million now can only afford 1.35. And there's the rub. Now you see. We are decreasing affordability in the name of increasing affordability. It sounds ridiculous, and I feel like maybe some of you don't believe me. This is just David, and he's riffing, and he's just saying this stuff. But if you follow the logic, guys, the CMHC wants to increase affordability for Canadians. So the way they're going to do that is they're going to lower real estate prices. How do you lower real estate prices? You make it harder for people to buy, so then they don't. Or you make it more expensive for people to buy, so then they don't. So when we talked about instituting a minimum 20% down payment for second properties, that made it harder for people to buy, so they didn't. Investors can't buy with 20% down when they were buying with 5%. Great. Less demand, more properties on the market. A minimum 20% down payment over $1 million? What? I can't get 107% financing anymore? Right. We're taking demand out of the market. We're making it harder for people to buy because if there's less demand, then we think prices will go down. So that is what the stress test was. And we still have the stress test to this day. But I would be remiss if I didn't flush out the thought that it was brilliant and genius in hindsight and unintended, because when we saw interest rates plummet after the pandemic and people started getting interest rates of 1.79%, we had to ensure that they could afford that mortgage if it was 3.79%, because that's the point of the stress test. Now, ironically, all of the talk in the last few years has been about what's going to happen when these people have to renew. Thankfully, the stress test exists. So if you had a 1.79% mortgage, you were stress tested based on 3.79. Of course, you might have to renew at 4.79, but at least we know that you're not maxed out at the 1.79. So I think I flushed that out, and I keep saying 7.9 a lot. It's very confusing. But I mentioned increasing CMHC premiums, and I wanted to come back to that. That was something that we saw before the stress test. It's something that they've done more than once. Now, the CMHC premium, as I mentioned, we call this mortgage insurance. If you were to buy right now for $500,000 with only 5% down, your down payment, quick math, is $25,000. The CMHC premium is 4% or $19,000. 4.1%, I think. So your CMHC premium is $19,000. And I'll break this down for you. You're going to pay $63.33 per month every month for 25 years. That's how you pay off the mortgage insurance. So keeping in mind, the CMHC, at the onset of this podcast I mentioned, puts on their website, CMHC is more than mortgage loan insurance, which I think that's really all they do. They backstop the banks. They make sure that the banks feel comfortable that if anyone defaults, hey, we're going to cover it. The cost of doing that is $19,000 on a $500,000 purchase with a 5% down payment, 4% of $475,000. So that's $19,000. So if you're buying that condo, and this is the tough part, you're buying a condo for $500,000 and you only have $25,000 down. Right? How the heck am I going to pay that $19,000? I've been scraping and saving and I've got $25,000 and I don't have to pay land transfer tax, or it's a little bit, like along with legal fees, I got a few grand. How am I going to pay that $19,000? Oh, no problem. You're only going to pay $63.33 a month. And that's how people are able to buy. So it is a good thing, sure. It's also maybe not so much because it kind of sucks. And what really kind of sort of maybe sucks is that $19,000 spread out over 25 years doesn't mean that when you sell it in 3 years, you just stop paying $63 every month. It means that you pay the entire balance off. I'm going to say that again. You bought for $500,000. Your down payment's $25,000. The CMHC insurance is $19,000, of which you're paying $63.33 per month. But 3 years from now, you get a great job offer in New York and you're going to sell this condo. You still owe the CMHC the balance of the $19,000. And the only way you're discharging that mortgage is if you pay them. And it's what? Quick math? $17,000? Yeah. That's how mortgage insurance works. So continuing along here, we increased our CMHC premiums. Then a few years ago, something I knew that was going to happen. When you saw the CMHC increase the minimum down payment for $1 million purchase or more to 20%, you still had from 0 to $999 was 5%. So you could buy a house at $999 with 5% down for $1 more than $1 million. It was 20%. And a few years ago, they decided we need to increase the minimum requirement on the portion of $500 to $999 to 10%. So now what it means, blend that. And if you're buying for $999, you're allowed to put 5% down on the first $500,000 and 10% down on the next $500,000 or $499,999. Your blended rate is 7.5%. So effectively what they did was they increased the minimums again. So on the one hand, my entire thesis here is on the one hand, they are strengthening our system. On the other hand, they are making it more difficult for people to buy. So for Joe Canadian, just makes it more difficult. Maybe now Joe Canadian can't purchase. But for the fictitious or not foreign buyer that's buying in cash, or to be honest, for anyone that's buying in cash, it's not a problem. They're still buying in cash. They're unaffected by interest rates. They're unaffected by minimum down payment requirements. They're unaffected by CMHC insurance premiums because they don't pay them. So in 2021, the next thing the CMHC did was tighten mortgage insurance qualifications. So again, I might say that this is helping to strengthen the system. The minimum qualifying credit score was increased from 600 to 680, right? Your credit score. And to be honest, both of those are kind of low. When I look at offers to lease, and I always look at people's scores, 800 plus, that's damn good. 700 plus is a minimum. So we're talking, again, minimum qualifying credit score from 600 to 680. And the gross debt service ratio was capped at 35% from 39%. That's your GDS. And your total debt service ratio, your TDS, was capped at 42% from 44%. Now, all this did, once again, was make it more difficult for people to buy real estate. But the CMHC kept giving us, we're going to increase affordability because we are taking demand out of the market. Now, they actually reversed course on this, which is absolutely amazing in 2021 because it's so rare to see any government really admit a mistake, but they scrapped this. So kudos to them. And then 3 years ago, I want to say, the first time I heard the term shared equity mortgage, some of you are probably starting to giggle, hopefully starting to giggle, a shared equity mortgage. So I first heard this rumor, a blog reader said, hey, what do you think about shared equity mortgages? And I thought, in what context? Oh, like if the government were to start helping people with their down payments. I said, that'll never happen. That's as crazy as, I don't know, the government forcing me to sign a document that solemnly swears that I sleep in my own home every night. Wait a minute. Wait, we do that. We do that. Yeah, there's a vacant home tax, and I have to swear to the government under penalty and fine that I sleep in my own bed in my own house that I own. Oh boy, tyranny. Where were we? Yeah, jokes aside, no, the shared equity mortgage. I thought that'll never happen. That's the craziest thing. And again, I don't want to make things too political. We all have our thoughts. I particularly don't think that the government should be helping people with down payments who can't afford down payments. I mean, there's a lot of ways to get people housing, and I would think that maybe focusing on low-income housing, subsidized housing, building rental housing, partnering with the private sector, incentivizing the private sector. There was a great idea to take HST off of the development for rental housing. And then they talked about maybe we should take HST off the development of new construction condos. Sure, that would definitely make housing more affordable. But why in the world would the government look at someone that cannot afford to buy a house and say, we need to help that person buy a house? So guess what? Shared equity mortgages introduced in 2021, 2022, and the government said, hey, we know you can't afford to buy a home, but we're going to share in it with you. So we'll give you part of the down payment. And of course, it was ridiculous. It was up to like $400,000, which is great if you want to buy in the middle of nowhere, center of Canada, throw a dart. But of course, if you wanted to buy in Toronto or Vancouver or Montreal or anywhere, $400,000 is ridiculous. Now, I think it was $500 in the end, but it was so absolutely insane. And I have to say that while I try so hard not to take pride in the misgivings, shortcomings of others, when the government scrapped this plan in 2023, I felt justified. I felt angry. And again, I don't want to make it political. I just don't see the government across the board, different parties, different people. I don't see people doing a good job when it comes to housing. And the idea that we are going to introduce shared equity mortgages was so ridiculous from the beginning. It was also unfair. It's unfair to the Canadian taxpayer to say, these people can't afford real estate. Let's help them afford real estate. It undermines and risks offending the entire concept of renting. Now, I've said this before many times. If you were to move today, get on a flight, land in London, England, or in Paris or in Tokyo, and you said, hey, I'm here to buy a home, most people would think you're nuts because very few people there can afford to own homes. And yet here we are in Canada where everyone simply expects to. We have a thing called rent shaming. Oh, you rent? Some of the wealthiest people in the world rent. In fact, some of the wealthiest cities in the world have an extremely high percentage of renting. And here in Canada, there's this idea that everyone should own. And again, I've said this before, I'm someone that makes their living from people buying and selling real estate. And I will go on record and say, no, not everyone should aspire to or should eventually own their own home. So the idea that the federal government is going to help people who cannot afford to own homes is completely flawed to me. I could speak forever on this, but I can tell you that as a Canadian taxpayer, as a real estate broker, as an amateur economics enthusiast, I just hated it. And I want to take off my tinfoil hat here, conspiracy theory joke, but this came out during an election year. And the problem, as I've always said with elections, the problem with politics in general, is that people get elected when they are popular or have popular platforms or ideas. So if you are a government and you say, we're going to give you free this, free that, free this, free that, free this, free that, we're going to give you free down payments for housing, well, you're vote buying. And so I don't know if this idea would have come out in a non-election year, although to be perfectly honest, and I'm sorry if you are a longtime liberal, I think that this was just an awful idea that they were going to implement eventually. And thank God they blew this thing up, pulled the plug in 2023. So let me just do a brief review here, guys, because I want to know why the CMHC isn't working for you. The CMHC's mandate is to help with housing affordability. Now, of course, as I joked, on their website, it says CMHC is more than just mortgage loan insurance, because really over the last few years, that's what they've been known for. They are backstopping the banks. But if their goal is to help with housing affordability, they have failed massively. Why isn't the CMHC working for you? Because they have spent the last 20 years focusing on demand side measures to try to cool the market. And as I noted, probably 2 or 3 times in this podcast, but I think another one is quite poignant right now. If your idea is to restore affordability by making things so unattainable, unattractive, or unaffordable that people don't buy, and that thereby reduces demand and then reduces pricing. It might be one of the most insane ideas I've ever heard. And I have kids that are 7 and 4, so you can imagine what kind of ideas they come up with. But the people that implemented this are our leaders. And they thought that instead of spending the last 20 years focusing on building houses, they decided that they should try to make housing more unaffordable and take demand out of the market. They did, however, as a byproduct, strengthen our banking system. And I mentioned this earlier too, as I'm trying to summarize this podcast, that whether that was the intent, which probably wasn't, that was, of course, a byproduct of all of their efforts to cool the market. 107% financing, long gone. They brought in minimum 5% down payments, which helped to strengthen the banking system and took demand out of the market. They removed a 40-year amortization, helped to strengthen the banking system, but of course, took affordability out of the market. They increased a minimum down payment over $1 million to 20%. That, of course, strengthened the banking system and it took demand out of the market. Investment properties used to be able to buy with 5%. Now it's 20%. Of course, what did that do? Right. It strengthened the banking system, but it took demand out of the market. The mortgage stress test, it made things less affordable, but it strengthened the banking system. The increase in CMHC premiums, well, that didn't increase safety of the banking system. That simply made housing less affordable. Tightening mortgage insurance qualifications, that takes away affordability. Increasing minimum down payments from $500K to $999K, from 5% to 10%, that makes real estate less affordable. And I don't even want to talk about shared equity mortgages again because that was so ridiculous. Guys, I just named 8 things that the CMHC has done since 2006, 7, 8. Every single one of those things, yes, the byproduct was it strengthened the banking system, but they weren't intending to do that. They wanted to take demand out of the market in attempts to cool the market, which is just totally crazy to me. The CMHC isn't working for you. They're just not. So I didn't call this podcast something like, is the CMHC working for you? No, I'm making a statement. This podcast is about why the CMHC isn't working for you. And whether you are filthy rich or whether you're dirt poor, whether you are, what did I call it, Joe Everyman Canadian, if you are that proverbial Joe Everyman Canadian, all of the things they've done in the last 20 years has made it harder for you to buy real estate. Now, I would also say that if their goal was to increase affordability, then they have failed you massively. So any way you look at it, whether the CMHC isn't working for you because their goal of increasing affordability failed, or the CMHC isn't working for you because their goal of increasing affordability took demand out of the market and made it more expensive for you, either way, they are not working for you. And I think it's quite sad. And I think there are a lot of people, and I'll typecast and say, perhaps older folks, on the one hand, more responsible fiscally, on the other hand, benefited from low prices and they've been there their entire lives and they could never afford a house for $30,000 like they bought in 1961. They're the folks that are saying, as a Canadian taxpayer, I'm 80, I've been paying tax for 60 years. I hate that the CMHC is backstopping the banks on the backs of Canadian taxpayers. So we don't hear a lot about this. It's not really a contentious topic. And I honestly would have thought it would be more of a contentious topic. Well, my cynical side says that if you ask 100 people in Toronto, what is the CMHC? Probably 30% will know what it is. It's that mortgage thing. And maybe 10% could actually say what CMH and C stand for. You know what? Maybe I don't blame them, right? Not everyone can know everything. But if you really look into this like we have just done, I will say that it is a massive crown corporation that is incredibly important. And unfortunately, it's failed. You, Canadians. So, hey, listen. Want to end on a more upbeat note? I think this was fun. I think this was great. And I think we covered a lot of ground. And that was pretty healthy. Kind of depressing that I've been in the business now for 20 years and I can remember every single one of these changes. But hey, it makes for a really great story. So folks, thank you so much for listening to this podcast. I hope you enjoyed it as much as I enjoyed filming it. If you're watching this, you might have noticed that my blue shirt turned to green. Well, that's what happens when you have all this tech gear and sometimes things stop working. Nothing quite like going back and filming right before the long weekend. Wherever you're listening, guys, please remember to like, comment, and subscribe. If you are watching on YouTube, please drop a comment. And if you are going away this long weekend, drive safe. Happy Canada Day. Thank you, everyone, so much for your support here on the Last Honest Realtor podcast.